Why? They chase hot stocks at the worst times, or they bail out when the media screams sell. This leads to stress, losses, and wasted energy. Going against the tide helps break that cycle of emotional decision making instead of getting whiplash from the market's ups and downs. You focus on real value. When you stop running with the herd, you often find stability and a more thoughtful approach, reducing that constant buy high, sell low pain. By losing beyond the crowd's noise, you may uncover stocks trading at a discount. When the market finally corrects itself, realizing a certain company isn't doomed after all, your shares could gain value while everyone else scrambles to jump back in. Another benefit is emotional clarity. Contrarian investing teaches you to stand firm on research rather than popular opinion. This approach can build confidence and strengthen discipline, both of which are essential ingredients for potentially beating the S&P 500 over time. In the stock market, many rush to buy shares of well-known companies that everyone's talking about. Meanwhile, a lesser-known business could be quietly performing well, boosting strong financials despite a slump in public opinion. Maybe they had a single bad quarter, or a rumor went around, pushing the share price down. If you dig deeper, like tasting that overlooked lemonade, you might find the product or the company is actually far better than people realize. While the majority stands in line for the big name, the contrarian calmly checks the fundamentals of the neglected stock. If the numbers add up, solid revenue, a reliable business model, smart leadership, this stock may be a hidden gem. Over time, as others catch on and see its true value, the share price could rise, rewarding those who invested while it was still unpopular. That's the essence of investing against the tide, ignoring the noise around the famous stand and looking for real value where few are paying attention. Just like in your lemonade stand scenario, the quiet option can end up quenching your thirst for gains more effectively than the highly publicized one. Try a contrarian checklist. Write down each reason why the crowd dislikes a stock. Then methodically gather data, like revenue trends, management strength, or new product launches, to see if each reason is valid. If you find facts that counter the crowd's narrative, you might have a legitimate contrarian opportunity. This systematic approach helps you see why the crowd might be wrong. The reality is, crowds often overreact. Nobody wants to miss a rocket ride to quick profits, but hype often inflates prices beyond real value, setting up a nasty fall for latecomers. Picture your grocery shopping. Suddenly, apples become the biggest craze, and their price triples. Do you blindly pay more just because everyone else is? Or do you look for equally tasty but cheaper fruit that might give better value? Contrarian investors do the second. They question the actual worth of a stock before joining the stampede. In the long run, hype-driven spikes can crash hard. By staying disciplined and focusing on the stock's fundamentals, you can skip the buy high sell low trap. True, you might miss some short-lived rockets, but you also dodge the heartbreak when they come back to earth. Meanwhile, you're discovering stocks with a more stable growth potential.